Hello, fellow investors. This episode is the repeat of episode 7. In this episode, you'll learn how to evaluate insurance companies as a value investor. This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 7 of Value Investing. In this episode, I'm going to talk about two topics. First, I'm going to go over the basics of how insurance companies make their money. And I'll also teach you how you can identify good insurance businesses and screen out mediocre insurance businesses for your investment. Second, we're going to go into the details of why Warren Buffett invested in an insurance company called Geico. So I think that this is going to be a very interesting episode. Before we get into the details, please subscribe to my channel if you haven't already done so. And please leave your feedback, and that helped me a lot in terms of putting together my episode for this podcast. Without further ado, why don't we get started? Let's talk about the basics of insurance business. I think it's important for you to understand the basics of how insurance companies are making money before we talk about individual companies that Warren Buffett has invested his money. And it's going to lead to the discussion of why Warren Buffett thought that this is a really great place to put his money in because he has some advantages. Insurance companies and insurance business can be broken into two segments. The first segment is primary insurance, and second segment is reinsurance. Primary insurance is a commodity product. In general, consumers of primary insurers care mainly about the price and the coverage that they are getting. And therefore, there's not much product differentiation across different companies. Think about last time you purchased car insurance. What you care about is the price that you're paying and also the coverage in case you get into an accident. So those are the two main factors to care about. And this one leads to an environment where companies compete for price very fiercely. And this kind of creates also an environment where inadequate pricing are prevalent, and which may lead to a lot of insurance companies going bankrupt in the future. The second segment is reinsurance segment, and this is a little bit different because you can have product differentiation power if you have the capacity of paying out large amount of claims by your available funds when it is most needed. For example, you can look at the area of mega catastrophic hurricanes or terrorist attacks. What you want to make sure as a policyholder is to pay the premium to your reinsurers. Well, you want to make sure that reinsurer has enough money to cover whatever claims that you can have in case of these big events happening. There are three sources of money when it comes to insurance business that insurers use in order to make profits. First, insurance companies can have money from policyholders in the form of premiums. And they don't have to pay this money out right away to their policyholders. They usually have a long time period before they pay out this money to policyholders. So this is called float, and this is going to be the main focus of this episode. And second source of money is just like other corporations, insurance company can issue their corporate bonds. And also insurance companies can borrow from other financial institutions such as banks. Finally, insurance company can also get money from its shareholders in the form of equity. When it comes to analyzing insurance operation performance, the main focus should be on the policyholder's money, which is float, and also its cost over a long period of time. The key focus should be on the float, and let's discuss a little bit further details about what this is. Float or available reserve is policyholders' money held but not owned by insurers. which comes about because there exist time intervals between received premiums and incurred losses to be paid out, usually more than a year. I gave you one example about car insurance. So let's say you get an insurance from Geico. What you do every month is, let's say you pay $100 premium. You pay $100 premium every single month, but Geico doesn't have to give you any money back until you get into a car accident. So there is a time intervals between received premiums and incurred losses. So this gives very great opportunity for insurance companies to invest your money for their profit, insurance companies' operations. Under a good management, insurance companies can have negative cost of funds. What does that mean? So if you look at other financial institutions like banks, what they do is they get money from depositors just like you and me, and if I open savings account from Chase Bank, then Chase Bank is going to give me interest on whatever money that I put in. So the cost of money is going to be positive for Chase. But insurance companies do not have to pay me anything back until I get into an accident. Insurance company can have negative cost of funds in that regard. So I'm actually paying more money in order to keep the funds in insurance company's bank account. If insurance company operates under underwriting profits, then it means the cost of fund is free or even negative, as I just mentioned. In other words, insurance companies are paid to use the float. And in this case, the float, defined as liability on the balance sheet, could function as an asset, which determines the value of insurers. It's even better than assets. So what a lot of investors are looking at when they look at balance sheet is that they look at the liability side and they don't like the items on the liability, and they only like the items on the asset side of the balance sheet. But in this case, if insurance has really great history of operating with underwriting profits, then the more items on the liability side, it's the better for the investor. This is the key concept that you need to understand when you analyze insurance company. In order to understand what is good operation, you have to look at a ratio called combined ratio. So combined ratio is calculated as follows. Numerator and denominator. Numerator, you put incurred losses plus expenses, and denominator is earned premium. So when combined ratio is equal to 100, that means incurred losses and expenses are the same as earned premium. Because insurance companies make some investment profits by reinvesting the money from you or other people's policyholders, combined ratio equal to 111 is generally considered break-even point for insurance companies. That's operations side of an insurance company. And if you look at investment side, what's important is once insurance companies get money from you and other policyholders, they have to invest this money in somewhere else, just like banks do, in order to create some investment income for insurance companies' business. So it's quite important to keep the combined ratio below 100. And also it's quite important to invest the money in a good places where insurance companies can get the profit. As in other depository institutions, insurance companies should invest funds intelligently. And when investors usually look at how insurance company invest their money, they look at bonds and equity ratio in order to determine whether insurance companies are investing their money conservative way. However, this is where Warren Buffett shines, because Warren Buffett has the ability to invest money at a very, very high compound rate. And Warren Buffett also knows how to spot good insurance companies where combined ratio is below 100%, which means the cost of funds is basically free for Warren Buffett to invest at very, very high compound rate. This is like aha moment for Warren Buffett. Warren Buffett knew from the get-go that he was able to invest very high return area. and he wanted to have some free money from other people. This insurance company is the perfect vehicle, because if you find good insurance company generating underwriting profits or combined ratio below 100%, then this is kind of the dream land for Warren Buffett, because this is technically leverage, but you don't have to pay the cost associated with leverage, but you can invest this significant portion of money at a very, very high compound rate. Okay, so we've talked a lot about insurance basics so far, and if you are new to this field, you're probably thinking to yourself, what the hell is he talking about? So let me try to take a step back and try to summarize what we have just discussed so far right now. I think it's important for you to understand, instead of me just rushing into explaining all these concepts within a short period of time, I think it's important for me to summarize so that you understand exactly what you need to look for when you look at insurance companies. And it's also important for you to understand this concept before we discuss Warren Buffett's insurance investments, such as Geico. So there are 3 questions that you have to ask when you analyze insurance company, and this is exactly the same exercise Warren Buffett has gone through. First question that you have to ask, and this is an important one, is how much float does the company have right now? And the way you can answer this question is by going to balance sheet of the insurance company. So you have to identify items related to policyholders on the liability side and add them up. And you have to subtract all the items related to policyholders on the asset side in order to calculate the float. So let's just go over some of the items. So items related to policyholders on the liability side include loss and loss adjustment reserves, unearned premium, fund held under reinsurance assumed, other policyholder liabilities. And if you go to items on the asset side related to policyholders, include premium receivables, loss recoverables, deferred policy acquisition costs, deferred charges on reinsurance, prepaid taxes. So these are very technical right now. Probably you don't understand fully about all these items. So I'm going to put these items in the description box of this episode so that you can do your exercise after you listen to this podcast. Now that you know how to calculate float using balance sheet items, the next question that you have to ask is, what is the cost of the float for this insurance company? And as I mentioned, you can use combined ratio in order to know whether insurance company has been operating in a profitable manner. So for combined ratio, you have to go to income statement. So there are 3 items that you have to use in order to see if the company has been operating in a profitable manner. So combined ratio is equal to incurred losses plus expenses divided by earned premium. So these are the 3 items that you can find on the income statement. You can look at this combined ratio over the past 10 years and see how insurance company has operated between different business cycles, because insurance company, as I mentioned, can delay their incurred losses for many years in some cases. So it's important for you to look at many years of insurance business cycle in order to see the attractiveness of the company's business model. Once you know how much float that the company has and what is the cost of this float over many years, the last question that you have to ask is, what would be the growth of this float in the future, and is it possible for companies to generate more float at very, very attractive cost? And this is not easy question to answer. Just like other companies in different fields, the future is always uncertain, But something that you can look at is if it's a primary insurance company, then you can take a look whether or not this company is a low-cost operator. A lot of customers of insurance companies care only about price, and that's what I mentioned at the beginning of this episode. And in order to win this game, it is better if you are low-cost operator. You can always undercut your competitor's price and provide more value to your customers. And competitors would not be able to match your price because if they're not low-cost operator, they're going to go bankrupt. One good example of this great business model is Geico. Geico had very great business model where it's operating very, very low cost compared to its competitors. These are the 3 questions that you can ask to identify whether or not the insurance company has great business model and can survive in the future. Once you identify good insurance companies by asking these 3 questions, the next thing you have to do is to determine whether the insurance company is selling below its intrinsic value. So you can compare the market capitalization of the insurance company against the float the company has. You already did your research and determined that this insurance company's float has been generated at very attractive cost. So once you're done that and screen out all the mediocre companies, what you can do is compare the market cap against the float. Because think about the float in this way. So if you look at other companies in different industries, then you compare price against the book value in order to find out good, attractive companies. Insurance company, float is very important. Even though this item is on the liability side, it is actually better than asset in many aspects because the cost of the float is negative for good insurance companies. If market cap is below the float, and if you can get, let's say, market cap over float ratio is below 50%, then that's extremely undervalued insurance company. Also, you can look at price to earning ratio just like other companies in different industry and see how much this insurance companies are producing its income and compare that against price. So those are the 2 key ratios that you can look at. You also want to understand whether the float has been shrinking in the past and also whether there is a good prospect of having higher growth rate of the float in the future. Okay, I think we've discussed enough about how you can evaluate an insurance company. So why don't we switch gears to Warren Buffett's insurance investment that is quite famous, Geico. Geico is auto insurance company, and you probably heard of their marketing slogan that says 15 minutes can save you 15% or more on your car insurance. Buffett first learned about Geico when he was at Columbia Business School. His professor Ben Graham sat on the board of the company. Warren Buffett told reporters previously a very famous anecdote how he got to know Geico. On a Saturday morning, Warren Buffett went to Geico's headquarters without making any appointments there. The building was empty and locked, and Warren Buffett knocked on the door until someone answers to the door. And there was luckily a janitor cleaning the building, and he opened the door for Warren Buffett. And Warren Buffett explained his situation. He said that I came all the way down here after taking a long train ride. Can I meet anyone in this company? It was lucky for Warren Buffett because at that time, then investment officer Lorimer Davidson was there, and he was willing to talk to Warren Buffett about the insurance company's business model. Mr. Davidson became CEO later, and Buffett became the owner of entire company. So this is quite interesting anecdote. After the meeting with Mr. Davidson, Warren Buffett was quite impressed with its business model and invested a significant portion of his money back then when he was a student to this one single company. Mr. Davison explained why Geico has very attractive business model, and it comes from being a low-cost operator. Geico sells its insurance policies directly to its customers without going through insurance agents or branch offices. So customers can get standard auto insurance policies at premium discounts running as high as 30% off manual rates. So this is a huge benefit for customers. And the operating cost of Geico was about 13% of revenue, whereas other insurance companies were running about 30% of revenue when they incur operating cost. This one translated to very high profit margin, and during the first half of 1951, practically all insurers operated in the red, while Geico's profit margin was cut to slightly above 9%. It is not easy to replicate this business model by other insurance companies, so there was huge cost advantages for Geico. And this is what Mr. Davison told Warren Buffett when he visited insurance company. In 1951, Geico was selling at $42 per share, which translated into P ratio of 8 when it experienced very high level of growth. And Warren Buffett believed that growth is gonna last more because it's a low-cost operators. Customers would come to Geico to get better policies compared to other insurance companies. That actually led to Warren Buffett investing 75% of his money in this one single company when he was a student. So that's why he loved so much about Geico. So this was the first investment by Warren Buffett. And later, after 1 year of investment, he sold Geico's shares at 50% of profit. After he sold his shares, Warren Buffett forgot about Geico for a long time. However, in 1976, Warren Buffett got interested in Geico again when it was in a serious trouble because then CEO Norm Giddens focused on the strategies that increases growth of the company's premium but at the expense of underwriting profits. The company was on the verge of bankruptcy and the share price dropped from $61 to $2 per share. As a result, then CEO Giddens was fired, and it was quite a scary time for Geico shareholders. However, Buffett knew that Geico still had a structural cost advantage despite the many negatives, such as the business being far under-reserved for its policyholders' future claims. Geico turnaround began when Jack Byrne took control of the company as CEO in 1976. Buffett wanted to know this guy and set up a meeting with him, and came out from the meeting reassured that Byrne is the right person to lead the company. The company was experiencing $190 million net loss in 1975. That translated into approximately $7 net loss, and the company had 124% combined ratio on $900 million premiums written in that year. Buffett made a bet that Jack Byrne can turn around the company in a profitable manner. Let's just do back of the envelope calculation just to see how we can assess the intrinsic value of the company. Let's assume that $900 million premiums are cut in half to $450 million. And let's assume that Jack Byrne can turn around the combined ratio from 124% to 95% level, which is reasonable level. Then the underwriting profit would become $45 million. If we also assume that we can translate half of the premiums into the float, so that we can invest this money at the prevailing interest rate of 7%, then operating profit for Geico would become $1.5 per share. For the sake of simplicity, if we assume PE ratio of 10, then the intrinsic value of the company would become $7.5 per share. Buffett paid on average $3 per share for 1.3 million shares of Geico in 1976. If you understand the concept of margin of safety, which represents the difference between intrinsic value and market value, the more margin of safety is, the better. Buffett had 50% of margin of safety when he purchased Geico share. Remember, our back of the envelope calculation for Geico was done assuming that the business volume is going to cut in half. So it was very conservative intrinsic value calculation, but even so, we had 50% of margin of safety. The rest is history, and Buffett made tons of money from Geico investment, and he repeatedly mentioned his love for this company. Okay, in today's episode, we discuss a lot about the basics of insurance companies' business model and also Warren Buffett's investment in Geico. In the subsequent episodes, I think I'll talk about two more insurance companies. The first one is National Indemnity Company that Warren Buffett invested in 1967, and another company called General Lee that Warren Buffett invested in 1998. So the reason why it's important is because Warren Buffett made tons of money from insurance business, and as an investor, you're going to have better advantages because a lot of retail investors do not know how to invest in insurance companies and why it makes tons of money and has better business model than other companies in different industries. I hope you enjoyed this podcast. And before I end, you can subscribe to my channel in case you haven't already done so. And I'll continue to discuss about Warren Buffett and his investment strategies in the future episodes. Thank you very much and have a nice day.